A common question I get a lot is, Christian, can you tell me what you think about XYZ? Or can you tell me what stocks you're buying now, or what stocks I should buy, etc., etc. This is where you insert the disclaimer, I'm not a licensed financial advisor, yada yada. No, I don't want to do that. I will give you access to my portfolio, let you see what I own currently, but I'm not going to tell you what to buy and sell, that type of thing. That's not what I do here. I want to educate you. I want to encourage you to educate yourself. I want to walk with you as a mentor down the road. I don't want to carry you, you know what I'm saying? After everybody, Christian here. Today I'm going to be sharing with you some insights into the stock market, and I'm going to assume that you know nothing, and I'm just going to start to build from there. I'm not going to cover every detail because it would just bog us down and wouldn't get anything done. So I'm just going to give you a rough overview, kind of provide for you a framework to look through or to measure things so that you can kind of start to see what I see whenever I'm looking at the market. All right, the first thing I would say is that the stock market is a place people go, like a market of any other type, a fish market or whatever, and you go there for a particular thing. In the case of a stock market, you go there looking to buy or sell stock. Stock is simply a piece of paper. Back in the day, it was a stock certificate that you would purchase that would tell you how many shares you own of XYZ company, maybe Walmart, maybe Target, maybe AT&T, somewhere in the US. That's what I'm talking about because that's where I live. But many different stock markets exist all over the globe. And people ask me, Christian, can I still use this information even though I live in Australia or I live in India or I live wherever? Yes, this information will work anywhere. It will be slightly different, of course, how things are reported and things like that. But by and large, the principles are the same. When you go to the United States, maybe California, whatever, and you pan for gold and you find gold, is it got value? Yes. Is it a good thing? Yes. When you go to India and you find gold, yes. Is it a good thing? Yes. So no matter where you're at, gold's gold. Your job as an investor is simply to find gold. And now it's a little bit different. It's not yellow shiny stuff, but it's going to have the same concept. There's going to be value that you are able to find that other people overlooked. So let's go look at this. The stock market, like I said, it's a place where you would go to acquire shares or ownership of a company that you want to buy, or maybe to go and sell shares of ownership of a company that you want to distance yourself from, to sell and liquidate, turn into cash, right? So what's important about this detail is that there are two different distinct elements here. There is the stock market where shares are traded and they fluctuate in price according to the moods of investors. If you're really excited about a particular company, you might be willing to pay more than if you were really in a bad mood regarding a particular company. If you thought the company had no prospects, you would pay very little for that company. So the price of companies fluctuate every single day, every single minute. And it's important that we take note that price of stock certificate fluctuating is not the same thing as the business fluctuating. The business can be solid, can be growing, can be, all kinds of positives about the business can be going on at the same time period that the stock price is going down. So it's important that we make that distinction. We understand what we're talking about when we talk about a stock market crash or a stock market panic or a recession or a depression or these types of things. Those things will all have a negative effect on stock price, but it may not necessarily have a negative effect on the business. So that's the detail that we have to really understand from the beginning and try to come to terms and analyze the situation and ask ourselves, stock prices are down, is it right? Should it be down? Or is it temporary overselling of a great company and we want to take that sell-off as an opportunity to go in and buy it at a discount and hold on to it for the long term? That's basically what an investor is doing. And I say investor because as a trader, you're looking at stock price and you're saying stock price is down, I think it's going to go back up, so I'm going to buy it and expect it to go up. Or it's down, I think it's going to keep going down, so I'm going to sell it and keep expecting it to go lower. You're basing your entire system off of price. And that's a flaw. That's something that will cause the majority of people who try it to lose money over the long term period. So it's just not a great strategy. What would be better would say, okay, I want to be an owner of a great business and I'd like to buy that great business at a great price. And if I can do that, I want to hold on to that great business for as long as that's a great business. And oftentimes that means you will buy a great business and then pass it on to other generations because it's still a great business. Look at Coca-Cola. It actually was traded back before the Great Depression, went through the Great Depression, and we still have it today. It's still a great company. So there's lots of opportunities in the market, and there's lots of people who are short-term minded, and they're looking to only own what's going up right now, and they're looking to sell anything that's going down right now. And so you get extremes in both directions. We just want to go in there and say, I'm looking for great businesses being sold off. My job is to analyze businesses and then compare it to the price and say, hey, that makes sense, or no, that's off. I'm going to take advantage of this. All right, so this is a picture of a chart of Walmart for the past 5 years, I believe. And if you look at, I believe it was 2016, you see that Walmart's stock price fell from about $81 a share down to roughly $51 a share. That's about a sell-off of roughly 35%. And I did the math on a calculator. And then we have to ask ourselves, we have a massive sell-off like that, has the company lost 30% of what it had? Did it lose a massive amount of revenue? Did it see a massive loss on the earnings? Is this a temporary issue that was plaguing the company, or is this a long-term structural issue that's going to be the start of a massive sell-off? In this particular case, I didn't see any reason for the massive sell-off other than short-term, and I thought it was a great entry opportunity. I think at the time, at the low, it had a dividend yield of about 3.5%. Before we go any further, let me explain a dividend. A dividend is simply the company's making their profits, their earnings, and they're taking a portion of their earnings and they're giving it to the shareholders in the form of a dividend, and they're just sharing the profits of the company with the shareholders as they go. Some companies pay a dividend, some companies don't, but most dividend investors like the dividend because it's the proof in the pudding, and so to speak. So the company has been able to pay out cash, and they're doing this consistently, and they're growing that dividend, the amount that they're paying the investor, the shareholder, over the long term. That's a sign of a company that's got cash growing over the long term. So it's a really helpful little tool that investors will use to kind of gauge the trustworthiness of this company's reported earnings and things of that nature. There's a lot we could say about that, but I'm not going to go into it. I was trying to give you a rough idea of the concept there. But when we overlay dividends on the stock price of the same company, we can see that the dividend is very consistent, very strong in certain companies, and lacking in all the volatility that you see in the share price. And that kind of gives you a better understanding of what I'm talking about when I say there's a difference between the stock price and the company's fundamentals. When you understand that concept, you start looking at good quality companies being sold off substantially as a good thing. It's no longer, oh, horrible, the stock is down. It's actually someone, ringing the dinner bell saying, come and get it. So it's basically your job is to look at situation after situation after situation and say, do I see an opportunity where some good quality is being sold off temporarily by people who don't know what they're doing, or by people who are not long-term investors. So that's what you're basically trying to do. One more awesome detail about what I like to do is, which I go and I find mid or large cap companies that are sold off temporarily. So I like to find a good quality company that's on sale, and then I like to also see that they have a dividend. They don't have to, but I like it to have a dividend because it gives me cash for waiting. It's like putting money in the bank and you're getting a nice little yield from that. So for me, when I look at different companies I want to own, I start by saying, hey, does it pay a dividend? Is it sold off substantially? And I'll look at PE ratios and things like that. We'll talk more about that in the future. There's various different ways we can analyze it. And then I look at what's driving the share price lower. Is this a temporary setback or a temporary bad news that's maybe plaguing the industry the company's in, whatever? And then if I can see that it's not a long-term detriment to the company, then of course I'm going to take advantage of it and just stick it in my portfolio. And of course you're going to maintain the discipline of a diversified portfolio, because sometimes you just don't know what you don't know, and you don't want to get caught with all your eggs in one basket. Okay, I think that's enough for this first video. Before I go, let me tell you that there's been a question being brought to me multiple times. People say, hey Christian, will you tell us what companies you like, what companies you're buying, things like that. I like to steer clear of that. Not that I won't in a certain way, but I want to steer clear of that because it's your job to get the education so that you can actually determine what companies you like and what companies you don't. A lot of times when you give people an easy out, they'll take it. So I will make my portfolio accessible to anybody who wants to see it. If you support ChristianProphetic.com, you go to the website, you make a donation, you can write in the comment section of the donation portfolio. And I will actually email you a snapshot of my portfolio. You can see what I own right now. But keep in mind, I purchased these things with the intent to hold them indefinitely, probably just pass it on to my children and so forth and so on. And I'm not giving you this as, hey, I want you to go buy these companies. This is what I own. You can look at it, you can learn whatever you can from it, but that's it. Don't take it as a buy list or a sell list or anything of that nature. For those of you who would like to get started investing or trading and you don't know really where to go, you can use Robinhood. It's a link in the description below. If you use that link, you will get one free share when you sign up to Robinhood, and I will get one free share because I referred you. And so that's an awesome little feature for you. I'm coming close to the max that I can refer and get a benefit from. Robinhood only allows you to gain up to $500 in free stock before they cut you off and say that's it, you can't get any more. So I might actually drop my wife's link in the description below, just so I can make that $1,000 total as opposed to $500. Always thinking. Why would you use Robinhood? Because they don't charge a commission, which is hugely beneficial to investors. They don't charge a commission. There's no fees, and they don't require you to have any certain amount of money deposited into the account or whatever. So it's a really big positive for that. However, it doesn't really give you a lot of tools. And so if you're looking for information on companies and a lot of that fundamental stuff, you probably have to go to something like Yahoo Finance or something like that, Google Finance, to get free information that'll be a lot more in-depth than what you'll find on Robinhood. Having said that, no commissions is a huge benefit. And regarding the free shares that Robinhood gives to investors, it's not like a penny stock or something like that they're not giving you something like that. But they also give higher priced stocks, as I got yesterday one share of Berkshire Hathaway B-class stock, and it was $204 for one share, and it's Berkshire Hathaway. It's Warren Buffett, man. That's awesome.